right. Welcome back to all of our listeners. Many of us are in the midst of getting our taxes prepared for 2024. And so while we have tax on the mind, we thought it would be timely to talk about ways that we can minimize tax liability, important tax strategies that not only apply for 2025, but also beyond. So we're going to talk about some things that apply specifically for this year in 2025. We're going to talk about some just general tax strategies that might apply this year and going forward. So, but to kick off this conversation, Randy, you had some updates that you heard regarding audits.
Well, there's been a major shift because of the Trump administration. So a lot of IRS agents are leaving. I mean, we're talking in droves, a large number. And the article in the Wall Street Journal I just recently read is that audits most likely are going to go down. Now, again, that's not an invitation to cheat the IRS. Right. But what I'm saying, your probably chances of being audited are probably greatly reduced. Again, the percentage of people that get audited is pretty minor. It's not a big deal. I mean, if you're in the habit of trying to cheat the IRS and falsify your information, shame on you.
Right, you've got other issues at hand,
Exactly.
But we always like to start off with good news.
Yep.
So maybe the chances of an audit this coming year might have reduced for the average taxpayer. So that is good news.
Yeah, it is.
That's good. And one of the things for this episode, we're talking about, the longer term tax planning. We're not tax preparers, of actually filling out the forms and doing that for our clients. But we do a lot of tax planning in the long term, multi-year strategies, making sure that you're making use of the different items. What we don't want to do is get to the end of the year and look back and say, oh, should have done better. Oops. We want to look forward and say, what can we do this year that's different than last year? And the timeliness of this is a lot of people, like you said, Laura, they're thinking about taxes right now. And so we're not talking about
2024 in general, the market had some high returns. And so for those who were able to take advantage of that, they may or may not have had some surprise tax bills at the end of 2024. Now, for good reason, because they've had tremendous investment gain in the account. However, no one likes to be hit with a surprise tax bill.
Yeah, and again, the last 2 years, the returns have been significant. So if you're going to take your gain, whether it be short term or take your tax loss harvesting, you needed to do that before the year end, before December 31st. That could have created some unexpected income, and now all of a sudden you're going, well, wait a minute, I haven't paid that kind of tax before. Well, it's because you took some profit, and it's okay to take profit. I mean, there's a time when you need to harvest, and I've always been a proponent of take some gains, pay your taxes on it, and do that. So anyway.
Yep,
right.
That's great. So as we look forward to 2025, I think the first one we kind of want to talk about was changes in the law. The 2025 is going to be an interesting year because it's potentially the last year for the Tax Cut and Jobs Act. That was back in
TCAJ, also known as TCAJ 2025.
So cut in taxes and job. I mean, did it work?
So Trump,
right, because it was started in 2017, I believe, right?
Yeah, 2017, 2018. So that's what kind of Trump's first time in office, and they put this together, and it did a number of things. There's a few that people were excited about, some people things they weren't, but it is set to sunset in 2025. So some of the key ones that we'll talk about today, the first one is your estate planning. When you look at your estate planning, each individual has a certain amount that they're exempt from what people call a death tax or an estate tax. And in years past, it was a smaller number. The Tax Cut and Jobs Act bumped it up to 12, 13 million or so. It changes each year, but we'll just say roughly 13 million per person. So for a married couple, wow, we're getting above $26 million in your estate that is exempt from estate tax. That means 99% of people don't have to worry about an estate tax.
And let's just talk about estate tax, right? It's 40%. This is
huge.
Not a light tax bill.
It's
this is a heavy burden. Bite. So that was a huge advantage.
Yeah. And so that increased amount has been, each year moving up a little bit, but in 2025, it falls back down to the prior amount. And so it's changed a little bit, but it's roughly 6 million per person. So 12 million for a married couple. That's still a big chunk of money. And there's still a lot of people who don't have to worry about that. However, there's a big chunk of people that do have to worry about that now. They know their estate is going to be over that amount, especially if they hold a lot of real estate. They could pretty easily get past that amount. So now they have these questions and concerns to say, do I need to do something different? And the answer, as lawyers love to say, is maybe. It depends. And it depends on a few things. One, on how their estate is structured. whether they need to start getting some things out of their estate. But two, what's going to happen with the laws this year? Based on the election and Congress and the White House, it appears likely, and a lot of people feel this is likely, that they are going to extend these higher balance exemptions, and they will continue in the future. No problem, no immediate action, but that's not guaranteed. And so
Right.
that's part of the discussion of a lot of estate planning folks are looking at, is there anything that needs to be done in 2025? And what I'm anticipating is actually will be nothing will happen. Congress will make a choice one way or the other, and then there'll be potentially a flurry of action later
Right.
part of this
Yeah, I
year
was gonna say,
trying to plan for
it'll
this.
probably be the last part of the year, right? So you're going to end up going, we don't know. Oh, wait a minute, there's a change here, right?
Yeah. So something to keep an eye on. I mean, no immediate action, but for someone whose estate is going to be above the potentially new exemption amounts, and they have some concerns about passing this on to the next generation, there's a number of things you could do in 2025 to kind of lock in the current exemption amounts. Often it's not advisable, to make those permanent choices, but it all depends on the law. So there's that. The other one is accelerated depreciation. There's a lot of businesses and even individuals who have been able to accelerate depreciation on certain items over a number of years. An example being they could buy a vehicle, a heavier vehicle for their work, and they could depreciate the entire expense in 1 year. That's changed years over year, and that's generally going away at the end of 2025. So something to talk with your accountant, to say, is there anything that we need to do this year if it does go away? Is there anything we need to buy or do in these years that we can still get in this accelerated depreciation?
And there's
those rules are very
requirements
specific.
I mean, there's details that you want to be really careful.
Yes.
I can't just go out and buy a $10,000 vehicle and depreciate it. It has to meet certain requirements to do that.
Yes.
Get that depreciation, get that allowance. So
yeah, so that's when to coordinate, and we always love it when we work with CPAs and enrolled agents who are proactive. Not just looking at the end of the year, what'd you do last year, but in the middle of the year, saying what else should we be doing this year to take advantage of some of these really good opportunities.
Right.
Yep. We have a great CPA firm here locally that we refer many of our clients to. We also are in the habit of working closely with our clients' CPAs. So, because we come up with the strategy oftentimes, and then the implementation has to be done together with their CPA. So it's just one of the services that we offer.
That communication is really critical with a tax person,
Let's jump over to retirement contributions and tax deferral structures and how critical these are when we're talking about long-term tax strategy. We're talking about 401ks, IRAs, Roth versus traditional IRAs, right? It can get a little bit confusing, and we want to maximize the value that each one of these vehicles can provide to us. So, where do we want to start?
Yeah.
I think you have to highlight that some plans are deductible. It actually reduces your taxable income, and some plans are not deductible, and they have more tax advantages at the end. So often people say, well, I probably should put money into a Roth. I'm going back to Jeremiah's comment. It depends. It may not necessarily be to your best advantage, but that's where we do the planning. But anyway, I just want to kind of emphasize
so to clarify for our listeners, Roth is after tax dollars. So it's not going to be tax savings now. It's tax savings in the future, right? So it's after tax money that goes into a Roth, and it's pre-tax money that goes into an IRA. So that's tax savings in the future. It doesn't mean you don't pay the taxes. They're just deferred to the future.
Right. And as Randy said, depends on every situation, but generally, if someone's in their early 30s, their first career, getting some money into a Roth is a phenomenal idea. They might feel like, I've never paid this big of taxes, but if they're beginning their career, the odds are generally that they're going to progress in their career and start making more and more money as they go on. And so even though it feels like a big chunk of taxes and they want to try and get that deduction, the reality is over time, they may still be in a lower tax bracket than what they will be in the future. And it might be a great opportunity to really boost up some Roths early, and then at some point switch over to their retirement accounts, the 401ks, and get the deduction later. But it depends for every person.
And you can do a combination of both in a given year. You can put a portion of your contributions into a Roth and a portion of it into a contributory plan that has deduction, right?
But it has a combined contribution limit. So the combined contribution limit right now is $7,000. If you're 50 years of age or older, you get an additional $1,000. They call that kind of a catch-up contribution. And then there's kind of a phase out depending on your gross income amount. So you do start to phase out of that total contribution limit depending on your income. So
Yep. And I think of there's the little plans, the IRAs. You have your own IRA. That was the limit you just talked about. People can get about $7,000 in there. Then you start thinking, oh, well, that's not enough. I need more firepower. Then you jump bigger to say 401ks. Through my work, either whether you're a business owner or a job that you work at, you have a 401k, and those limits are usually in the 23,000 was last year. It goes up a little bit each year. So that's the next bucket. And then even on top of that, you could add profit sharing. That gets a little bigger. And then we have a number of clients who are, physicians or lawyers. They kind of own their own kind of solo practice. We start talking about these cash balance plans where you can add, 300,000 or something on top of that.
Right.
And so I think the structure that's really important here isn't just, end of year, how much should I get in, but saying, hey, for the next few years, what size plans do we need? If you're a physician and you work on a 1099 structure, like a lot of emergency room physicians do, and you have your own company, you can set up a 401k plan with your own profit sharing, get 70,000 or so in there. Then you can add on top of that a cash balance plan and get, depending on your age and some other items, $200,000 to $300,000 in there. So you might have $250,000, $300,000 of income getting into these retirement plans without taxes. Now, that's not something you can just do on a whim, right? You have to set those up. But
that's
that's
a
the type of
unique tax structure for that specific type of industry and profession. Yeah.
But those are the conversations that we love to have, of saying, not just for 1 year, for this year, but really over the next decade, what kind of plans do you want to set up? And how much money do we want to get into these plans so that you can defer those taxes to a later time? So
Yeah,
that's the retirement planning that is so interesting.
If you're a real estate agent, right, a lot of times you're not aware that you can set up a solo 401k plan and you can contribute both as the employee and as the employer. So again, it's a unique scenario, but you can maximize your retirement contributions over and above maybe a friend of yours who's an employee and has a traditional 401k plan.
Yeah, now just one caveat. If you work for a company and they have a 401k plan and you wait till after December 31st, you cannot make more contributions to the participant's side. Again, it's done. So you have to be very careful about that. So a lot of these other special programs we're talking about, like cash balance, solo 401k, some of these others, you can wait till after the year and kind of put money back. So that's where the planning comes in. You have to be really careful about some of these plans. You're thinking, okay, I'll wait till after December 31st. Some of it you're done, and you can't go back and recreate the deposit. It just is done. So again, that's where the planning comes in. We've talked about this, we touched on it here in our conversation here. But so oftentimes I've had people come in and it's just too late. I mean, it's like, no, they wait till the last minute, and I'm going, we're trying to get together with you previously in the year, earlier in the year, and it's just, they wait till the last minute, and sometimes it can be really detrimental, right?
Right. If we're waiting to talk taxes until December 15th, and that's the appointment that you set, we might be too late to take advantage of the strategies that we can put in place earlier. So, good point.
Yeah, that's good. The other one I think on retirement planning is when people are in retirement, they start taking money out of these plans. And there's a number of thoughts and kind of advice in that side as well. Right. Some people, they're taking the money and they're living off of it. Others, as the money's coming out, they don't need the extra income. And so they start thinking about charitable contributions and, QCDs. Randy, you talk a lot about these, but qualified charitable distributions.
I'm a big believer in giving money away, the excess money. My belief is that if you've been blessed with a lot of capital and you've got great income, great assets, that you should be really focused on how much you should be giving that away. And not just to family, but to organizations that you feel strongly about. And QCD, Jeremiah, you touched on it, is a great instrument to do that once you reach the age issues and all that kind of stuff, right?
Yeah.
Right. So at a certain age, those required minimum distributions come into play. And it depends on what year you were born in, depends on what age you're required to start withdrawing from your tax deferred. So we're talking about IRAs, rollover IRAs, 401k accounts, right? They have allowed you to defer the taxes on that money until a date in the future when they start requiring you to take a certain amount every year. Now, in order to avoid paying taxes on those, one option is to set up the RMD as a qualified charitable distribution. And there's some rules around that. But if you are essentially to designate your RMD to go directly to a federally registered charitable organization, you can actually completely eliminate the taxes that would have otherwise applied to that RMD.
Now, there's a little, I mean, this is where the IRS hasn't caught up with itself. So originally, required minimum distribution started at age 70. Well, over the last several years, they've moved that up. So the QCD actually is structured for age 70, even though the required minimum distributions could be as late as 73 or 75. So you still could create a charitable deduction from your, even though you're not in required minimum distribution age requirements. So it's a quirky part of the law that hasn't caught up with the changes in the distribution. So again, you could do it earlier than RMD age and still get advantage of it. Now, again, how it works. Yeah. Anyway. And again, the purpose of that, and I don't want to belabor the point, but also the Medicare premiums are tied to this. So if you set this up, and again, you got to know which year and what you're doing, but you can actually reduce your Medicare premiums. Now, not everybody fits into this category, but for those that do, it's wonderful to be able to reduce the cost of Medicare premiums because it's based upon how they calculate your income in that given year. Anyway, it's just, I don't like the way the IRS has done it because they've not made it streamlined at all. So it fits for some people and doesn't for others. And anyway, that's where you have to do the planning. It's not a simple one and done kind of thing.
Yep. That's great. That's great. So I think our next topic, as we kind of talk about retirement plans, we kind of jump into what I would guess I call smart investing.
Yeah.
That, you know, when you invest throughout the year, there's someone managing your account or you're doing it yourself. And there's sometimes where you just put it in there and let it go, right? And kind of the long-term investor approach. But even in being a long-term investors, which we very much are, we're kind of a goals-based investing to say, what's the job for this money? But in the midst of this, there's a few things that people can do to kind of mitigate their taxes, especially when they're trying to move around their portfolio. And the key one is called tax loss harvesting. And so the idea is if you had two stocks that you bought throughout the year, one went down and one went up, and you've now gotten to the point where the one went up, you kind of want to sell them. You think they've had a good run, you're ready to get out of there, but you're concerned about that growth and those taxes that it's going to hammer you. Well, with tax loss harvesting, in essence, you would sell the one that gained. You'd also sell the one that lost to kind of zero out your taxes. And of course, no one likes to have stocks or holdings that have gone down, right? That no one likes that. But it is an opportunity to make use of some of those stocks or investments that didn't pan out the way you thought. Rather than just being bummed about it, you can actually liquidate them at the same time that you do some gains with the intention of offsetting those. And we've had a number of clients that were able to move the account around, massage it so it's still the best account for the future, but really have no recognized gains because they were offset with losses. It becomes a real powerful tool for folks to be able to really stay in a really strong portfolio for the future.
Right.
While not having to necessarily recognize gains or significant gains. You know, it's a really good tool.
And it's an exercise to rebalance the account, right? We regularly talk about diversification. So if with those two stock holdings, if originally you put $50 into each, and as the one that continued to gain in performance now is worth $75, and the one that lost is now only worth $25, then the percentage of the portfolio has shifted. And so part of that tax loss harvesting strategy is also an exercise of rebalancing the account so that you still maintain adequate diversification to keep the risk level low. So it's beneficial on multiple levels. The other thing that we want to touch on is just capital gains and how they're taxed long-term versus short-term, and that there is a net of the difference. So short-term capital gains at the end of the year, they net between the gains and the losses, and that is considered earned income or at earned income tax rates. Long-term capital gains, right? Same thing. They net the winners and the losers, right? And that has a different tax schedule. There's a preferential long-term capital gains rate. It's 0, 15, or 20% depending
it can
on
be
your
very
income.
Confusing, can it? I mean, you're talking about, where you hit the numbers or not and all those kinds of things. But yeah, I absolutely agree with it in the standpoint of process. But again, it takes work in order to reduce your taxable obligation to as low as you possibly can get without devastating your portfolio.
Yeah. And the last thing I think on investing that we often will talk about is the idea of householding. So if a household had 3 different investment accounts, one maybe is a rollover IRA, and one's a taxable trust, and then we'll just say you have 2 trusts, of how they do it. So they have multiple accounts. Well, there's some holdings that you want to hold in your total portfolio, but they just throw off income. Bonds, for example. Often they throw out interest, and that's coming back out to you. Some stocks have dividends that are coming out to you. And for some folks, it's fine. They're going to use that money. Others, they want to make sure that income that's being produced doesn't actually flow through to their taxes. And so they want to hold those assets inside maybe their rollover IRA. Whereas some other assets that they're planning just to hold, and they're just going to let it grow and grow and grow, maybe they want to hold that in their trust. And that it's not necessarily how you'd split it, but the idea is that you can look at all your accounts holistically. And that's often what we try and do, and put certain assets in certain accounts because the tax characteristics are different. And as we talked about before, it's not a short-term planning, right? That's a long-term, to say over the next 10 years, we expect these assets to do these things, and therefore we want to hold them in these certain accounts. So you're on a household level, holistically, you have the exact right portfolio you want. But each account could be a little bit different just depending on the tax characteristics of what's best to hold in that account.
Well, I hope to our listeners they found some nuggets of wisdom. There is some complexity to this. So if you don't have an advisor alongside you, please come and talk to us. We'd love to sit down and strategize and overall come up with a plan to minimize your tax liability over time, but also make you aware of how and when tax is applied so that you're not surprised at the end of the year. Good luck with all your tax preparation as you finalize it for 2024. Thanks so much for listening.
Until next time, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordatvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordatvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.